All right, guys, welcome to today's class. So I take it from the number of faces that I'm seeing today, we all want to pay less taxes, right? Okay. Yeah, exactly. And that's what this class is all about. It was mentioned that, you're not going to be coming after the class tax preparers or tax expert, but believe me, you're going to become a lot smarter when it comes to tax deductions and tax preparation, and you're going to have intelligent conversations with your CPAs or tax preparers when you have that discussion, or even among your friends. Okay. So as you know, today's class, tax deductions for realtors. As you all know me, I'm James Abdelmalik. I'm a realtor just like you. Been in the business for more than 8 years. I'm also the MCA of KW Coastal. But does really being a realtor and part of the leadership of Keller Williams qualify me to talk on this topic? So for KW Coastal Properties, I used to be an adjunct professor with Suffolk University. I have an MBA from American University. I have certification from Harvard University in advanced negotiation skills. I'm a CRS, CIS, CNS, PVS, and I also have awards and win top producing agents, and I have a YouTube channel with over 21,000 subscribers. Most importantly, I have a CPA background. I'm not practicing CPA right now because I'm a full-time realtor, but I can like to discuss topics to make it simpler to people so that they would understand the concepts that would benefit them, okay? As you know, I'm a certified market center instructor as well. Anyway, for today's agenda, what we're going to be discussing, how is income reported for us realtors, okay? How is income reported? What is the tax rate and what are tax brackets? I'm sure some of you are wondering this. What income is reported in the 1099? We're going to understand this in a little bit. What is a tax deduction? Qualifications for tax deductions. What is Schedule C? What are types of tax deductions? How to maximize your deductions, and a little bit in the end, bonus for me, tax planning. Okay. I know this seems like an overwhelming agenda, but believe me, we'll go through it smoothly, and feel free to stop me at any point because this is supposed to be presented. I made the presentation so that it will be simple for you so that you can apply it even if you want to prepare your taxes yourself. But I highly recommend you use a tax preparer, a CPA, to do so. But let's dive in. So how is income reported for us as realtors? As you know, we are considered self-employed and an independent contractor. And any independent contractor or self-employed person receive a Form 1099, whether you own a corporation or you don't. If you're an individual, you're still going to get a 1099. If you're a corporation, you can elect to receive a 1099 or not. But basically, that's how our income is reported as independent contractors. Okay, we don't get a W-2 because we're not a salary base. We don't work for an employer who determines our schedule and determines what we need to do. We work for ourselves. We determine our own schedule. That's why we receive a 1099. So how is income reported in the 1099? The important thing to know about the income that's being reported, 1099, I've been mailing all of you guys 1099 if you made any sales last year. All these 1099s that you receive basically are net of two things, okay? Net of the company dollars, whatever split you have with Keller Williams, whatever it is, and the royalty, which goes to KW International. So that always comes net to that. I'm going to give you an example in a little bit. But you still have to write off other things that you pay, like risk management, which we're discussing earlier in the team meeting, and the TC fees. Okay? Let's see an example of something you're all familiar with. You all seen the commission details. When you ever have an escrow where you need a CDA, you see the price of the property and then the commission, and then we deduct from it royalty over here, as you can see, and the company dollars. That net amount goes to your 1099. So if you did 20 of those in a year, in a calendar year, this all goes to your 1099. They're added up, and that's the number that goes to the 1099. So it goes net of whatever your share with Keller Williams is and the royalty to Keller Williams. Then we see some deductions in the end, like, for example, the TC fees, okay? And the risk management, which is the 149.
What's the TC?
Transaction coordinator, someone who prepares your files, upload it to opportunities so that you would, in the end, write this off. But we're going to go into details of what the TC fees are and what can you write off. But I'm just giving you an idea how income is reported on your 1099. Now let's talk about an important issue, tax bracket. What was your tax bracket? What does that mean? Go ahead. I'm sorry.
Okay. Just basic questions.
Yes.
So your $1099 you're giving me, you've already deducted those TC fees.
No.
So-
No,
Oh,
no,
you
no.
have
No,
not? Okay.
have not.
Okay.
For the 1099, we just,
That's on top of that for sure.
yeah. No. Then you get, let's say you made commission of $100,000 and then there was like 13,000 in company dollars and 3,000 in royalties. So you're getting, no, the 1099 is coming to you as $84,000. Assuming you made gross commission of 100,000, you're going to get a 1099 for $84,000. Okay? Not net of the TC fees. You're going to do that later on. Okay? And we're going to get what TC fees are. But thanks for the question. Very smart question. Let's talk about tax brackets. Every year there's a tax bracket that slightly changes or may not change, but you know, if you make income up to 11,600, that's 10%, and whatever is more than that is 12%, up to 47,000. Whatever is more than that, 22%, up to 100,000. Whatever is more than that, 24%, up to 191,000. So you can imagine where it's going with this, you know. So the higher you make in income, that applies to everybody in the US. The more you have to pay taxes. That's why tax deductions are good, because you can reduce your tax bracket going to from a higher tax rate to a lower tax rate. So there is no specific tax rate that you can, oh, you pay this amount, but whatever tax bracket you're on, that's what the tax rate you apply on goes. Okay. So now we understand the tax bracket. So depending on how much you made last year, you know what tax bracket you belong to. So if you made, like, let's say $200,000 on your 1099, most likely you're going to be in the 32% tax bracket. Okay. And it's going, you know, in that direction. So that's, any questions about the tax bracket so far? Okay.
I do have a quick question.
Yeah.
Are we gonna get or are you able to send us like a copy of your presentation?
Yeah, just email me after the class and I'll send you all this information. Yes. But most likely going to get it tomorrow because I have other things on my schedule today, but I'm going to send it to you. Don't worry.
Sorry, James, this is Emilio on Zoom.
Hi, Emilio.
Hey, how's it going?
I'm
Hey,
good.
just for transparency, just 200,000 at 35%, or I'm sorry, at 32%.
Yep.
That would be what, about 64,000? Is that what it is?
No. Oh, that's a very good question. Thank you for bringing that question up. It's not the entire 200,000. It's whatever 191, let's say from 191 to 200, that's taxable at 32%. Whatever is from 100 to 191 is taxable at 24%. Whatever is 140,000 to 400,000 is taxable at 22%. So when you add those line items up, you're going to come up with your effective tax rate. Does that make sense what I'm saying?
Right.
Okay, let me say it.
I'm just trying to equate it into what would be the dollar amount that you would be taxed. Does that make sense?
Okay. Before we do any deductions, let's say, for example, the 12%. No matter, let's say you make $500,000 a year, okay? The first amount of money you're going to make between 11,000 to 47,000 is multiplied by 12%. And then from 47,000 to 100,000 is multiplied by 22%. And then you add it up to whatever is 100,000 to 191,000 multiplied by 24%, and so on and so forth. But you don't multiply the entire, like 32% to the entire 500,000 that you made. You understand what I'm saying?
Oh, I got you.
Does
Okay.
that make sense?
Yeah.
Like weighted, right?
Yeah, it's weighted. So yeah, exactly. In Excel spreadsheet, you can make that equation. It will calculate it for you. But that's how it is. So it doesn't matter if you made $1 million. You're not going to be, for example, paying 37%. It's always going to take the gradual line item of the tax rates. Does that make sense to you guys? Okay. Okay. We haven't gotten to the juicy part yet. This is just information for you. This is All this is extra information that makes you smarter. This is something, extra, okay? But this is just information. This is like an introduction. But the important parts are coming up, But that's a good question. Thank you for bringing it up. Any more questions before I move to the next one? Okay. What are tax deductions? That's an important thing that we're talking about today, okay? So tax deductions are simply write-offs from your gross income, reducing your taxable income, so that it would reduce your tax liability, okay? So from the tax bracket, we noticed how it's calculated. Whatever rate you multiply and you get, there is a tax liability involved. So let's say after we multiply the 12% by the portion and the 24% by the portion and the whatever percentage, we got a number. That's your tax liability, okay? Or that's your taxable income that we're going through. So the objective of a tax deduction is to reduce your taxable income, so we pay less tax or less tax liability, okay? So a tax deduction will lower your tax bracket, hence you'll pay lower taxes. So if you're, let's say, for example, if we go back, if you're right now making 200,000 as an example, and you're paying over here like 9,000 and 32%, and you're paying over here 91,000 at 24%, and you're paying over here 53,000 at 22%. So every time you have a deduction, you're reducing your taxable income. From 200,000, now you're going to go to the bracket which is lower, to the 24%. Does that make sense to you guys? Okay. So what are types of tax deductions? So I organized it in a way, and just not calling it just tax deductions. I wanted to make it simpler for you. Tax deductions are three types. Business tax deductions, of course, related to real estate. Personal tax deductions, which anybody who makes files their taxes, there are certain tax deductions entitled to them. We're going to go through that. And there is investment tax deductions, okay? Like if you invest in stock or stuff like that. So, but for business tax deductions, there's certain qualifications that need to happen in order to use it as a deduction. Before we go into what the deductions are we're going to use, which is the main topic of what we're talking about. For a business tax deduction to be used, it has to have two things. It has to be an ordinary in the course of business, and it has to be necessary. Ordinary means common and accepted practice in real estate industry. You have to pay for a photographer, you have to pay for advertisement, you have to pay for a TC fee. Yeah. Hmm? Yeah, we're going to go into detail of that. Yeah. We're going to go into that. Don't worry. And it has to be necessary in order to conduct your business. So it has to have these two features in order to qualify as a business tax deduction. And the tax deductions are itemized either in Schedule C, we're going to see what that is, or Form 1120 if you have a corporation. If you're filing on your own, you don't have a corporation, you're going to use Schedule C. Your accountant will use Schedule C. If you have a corporation, you're going to have a Form 1120, which your CPA will fill out for you.
Just to make sure, so it's like a list of the items we can deduct. This is what these things show, right? The Schedule C. And
yeah, that's something. It's an IRS form. It's an IRS form. Yeah, like it goes with the 1040, with the Form 1040, Schedule C. But for purposes of today, I'm going to assume we're using Schedule C. I'm not going to assume you're a corporation because it will just overwhelm you. But basically, whatever you use in Schedule C, you can use in a corporation, but corporation just has a little bit more benefits than being on your own. But anyway, that's not the point right now. We're going to get to that in the end. So everything clear so far? So the 1099 either feeds the Schedule C or Form 1120 if you're a corporation. Let's assume we're all individuals and we have Schedule C. Okay, that's a Schedule C. You see how this, so your accountant fills this out for you and puts everything according to its category, according to its number, okay? And that's what Schedule C is. Now, what are the business tax deductions, which is the juice of today, or the main topic of today's presentation? I got a lot of tax deductions that we use in our industry, okay? And they're all qualified business tax deductions. Not all of them may apply to you, but most of them are. Let's go with the first one. Marketing and advertising. That goes in Schedule C on box 8. Of course, we spend a lot of money on marketing and advertisement. And I'm reminding you of what you can use under this category of marketing and advertising. The point of these business tax deductions, guys, is many realtors overlook a lot of deductions they can utilize, or they underutilize the deductions they can use because they forgot. They just rely that they have an accountant and here he's going to figure out everything. He's not going to remember everything that you spent, okay? He's not going to go and dig into what you have. He has like hundreds of other clients, okay? He's busy and he has other different industries. It's not not all his clients are realtors. He won't remember what details he can use or what you cannot use. So it's going to be your job to remember to track all your stuff. So first category of business tax deductions is marketing and advertising. If you have a website development, hosting, maintenance, business cards that you printed and spent money on, brochures and flyers, digital advertisements, billboards, online advertising, social media, Google ads, marketing costs, virtual tours, property promotions, for sale signs, open house signs, mailers and postcards, all what you spent money on in marketing, you can use that as a deduction under marketing and advertising, okay? So keep track of your stuff. And we're going to discuss this later on as best practices, okay? That's the number one tax deduction. I'm pretty sure all of you are familiar with this. Anybody was not familiar with this deduction before? Okay. Next one, licenses and dues. I think you all are familiar with this one. That goes in Schedule C, Box 23. This is all your MLS dues, your NAR dues, association dues, membership fees, board dues, the Supra fees that you pay every month. So whether it's monthly, quarterly, or semi-annually, or annually, whatever fees you pay for your license, you're renewing your real estate license, whatever kind of dues for the city of Long Beach or Seal Beach or Palos Verdes or whatever city you belong to, whatever you're a member for, all these things are deductible and they go in Box 23 in Schedule C. Anybody not know about that? Okay. Third one, vehicle tax deduction. That's a good one. One of the main things we do as real estate agents, we drive around a lot, whether to prospect for business or to show buyers homes. Our job is to drive, and the IRS understands that. So there is two ways in order to take that deduction. First method is called mileage deduction. And it changes from year to year. Last year it was 65.5 cents. This year it's 67 cents. So let's say you drove 10,000 miles throughout the year, okay? Showing clients. It has to be for business purposes, by the way. So that means you get to deduct from your income $6,700, okay? That's the first method. That's the simple method, okay? The other method is you go with the actual expenses of your car. Like you put in all the gas, the repairs, the maintenance, the insurance, the interest on the car loan, the depreciation, the lease, whatever it is, all this you gather up, but you have to have proper documentation and add them up. So you can use either A or B. You can't use both. So I know some of you are going to ask, so which is the best method to use? Mileage or actual expenses? Well, that depends on what's going to get you the most tax deduction. If you drive on a lot, like 15,000 miles, most likely the mileage deduction will be better, but you won't be able to deduct, insurance or gas. But if not so much, you can actually do both and see which one gets you more deduction and then apply that to your tax return. Let's say you calculate the mileage and it comes out to $8,000 and you calculate your actual expenses, it comes out to $9,500. Then you go with the actual expenses in this case.
Depreciation can only be used in case B.
Yes. Yes, ma'am.
Like last year, if you did mileage, can you use actual the year after?
Yes, you sure? Yeah, yep. It's not a problem. But always confirm with your tax preparer, but I'm pretty sure you can do that. Yes, it's not a problem. As long as you don't do it like in the middle of the year, I'm going to try to, it's only for the year you're preparing. So yes, you can switch whatever is more convenient for you. Any more questions? Yes.
Seems to
Okay.
me that because you've got personal mixed with business,
Yes.
it's easier to track the miles, business miles than it is. Okay, well, I filled up my tank on Tuesday.
Hmm.
That was $43. And I used $8 worth of that for personal and
Yeah, I know, yeah, if you're using the first method for the mileage deduction, you're gonna have to keep a log of all the miles you use for business. But for actual expenses, I don't think they're gonna police, the IRS is gonna come and police, no, show me the other receipts you did for personal or not. I don't think so. That's what I'm trying to say, but for the mileage, they're gonna look for, you know, go ahead, yes.
If I have a corporation and I use only the debit card of the corporation,
Debit card.
do I need receipts to collect receipts for the gas and everything? Everything is being done through the company's card.
Yeah, this can be used as well. Yes, you can use, because you have a proper statement on a credit card bill, that you can use that. Yeah, that could be something very verification. Yeah, this, yes, Brandy.
Do you have different apps that you can track the mileage?
I used to know an app. I just don't remember right now. Yeah, I think that's what it's called. Yeah, I think that's it. Yeah, MileQ, yeah.
Mile.
IQ. Yeah, this is an app where you would just press the button, you're doing a business trip, and it will just record. Yeah.
GPS thing.
Yeah,
When I drive from my house to
Yeah.
here, it totals it, it says, and then you swipe left or swipe right
yes,
based on whether that
Yeah.
trip is business or personal.
yeah, exactly.
Well, there is a free version, but you only get like 20 trips per month.
I know Stripe is,
It's like $10 a month. If that.
And then you can write that off because that's.
Yeah. Okay. So this deduction, the vehicle tax deduction, as I mentioned, you have two options, and this goes on Schedule C, Box 9. Fourth deduction, meals tax deduction. That goes on Schedule C, Box 24B. We all love to have a good meal. We all like to go out and eat. But believe it or not, we can use that as a tax deduction as long as you're taking a client out for dinner, okay? Or you could be taking your agent friends, or you can be taking a potential client, as long as you're discussing business, okay? So what the IRS allows is like 50% of the receipt for each meal, and you have to document a reason why this meal took place to start with, whether it is a client, whether it was an agent, a co-worker, a friend, but you have to be discussing about your real estate business. So that's something you can use when you go out for dinner. Let's say you go out in an expensive restaurant, make sure you bring the topic of real estate, and remember that topic, put it on the receipts, and yeah, and you can deduct it, yeah,
we should, by documenting,
yeah, 50%, yeah.
technically speaking, how do you document this? Like, do you write on the receipt that what?
Yeah, just assuming you get audited, yeah. That's because we were assuming worst case scenario. The accountant is never going to tell me and show me the receipts and show me the reason. But in order to anticipate worst case scenario that you get audited, when they see a receipt and you have documented on it what was the purpose, then that's fine, you're good. But they're not gonna go every one. Yeah. Your accountant just wants to get over with. Yes, Teresa. Yeah, anything. That's okay. As long as there is a business purpose to it, about real estate for our case. Any further questions about that one? Okay. All right. Next one is education and training tax deductions. That goes on Schedule C, Box 27A. So, in order to be successful in our business, we need to take training. We need to educate ourselves more. We have to be learning based. We have to invest in ourselves. We have to make professional development on ourselves. So any online courses we take, we can deduct that. Professional coaching, if you're paying to a professional coach, you can deduct that. If you buy real estate books to enhance your learning, like Millionaire Real Estate Agents, The One Thing, things like that, you can deduct that. Real estate trainings that you attend and pay for, like Bold, for example, you can deduct that. Real estate conferences, like if you're going to family reunion or if you're going to mega camp, you can deduct that. Real estate designations, like if you want to become a certified investor agent specialist, certified residential specialist, whatever kind of designation you're getting, you spend money on that, you can use that as a tax deduction. Any continuing education required to renew your real estate license. All what is related to education, or training, you can deduct this and take advantage of that deduction. The problem is not many people remember what they spent on. Oh, I took both last year and I forgot to claim it. For example, oh, I went to family reunion. I forgot to put the ticket that I put on for that, you know. So you got to remember that stuff because your accountant, no matter how good he is not going to remember the details of what you spent. That's where you come in when you have proper bookkeeping in place in order to claim your deduction. Any questions about education and training tax deductions? Go ahead.
But what if you're starting out agent, haven't sold anything? Are these things still?
Yes, oh, yes.
Yes, you did spend the money and your real estate, yeah, and yeah.
Putting all this money, getting the business cards
Yeah.
and doing all this stuff, so you can.
It happens, yeah. Sometimes your business and some, yeah.
Good.
As long as you have all these, that's why you should keep receipts in place, you know.
Hold it.
You may operate as a loss
Yeah,
the first year, 2 years, whatever, until you're making money. But yeah,
okay. Just wanna-
definitely still deductible.
Okay, thank you.
Okay, next one. I'm sorry? Yes, yes. Yeah, like for example, to become a certified residential specialist, for example, or a certified investor agent specialist, a Palos Verdes specialist, like the designations I had in the beginning, if you notice, that's all these designations are something you can deduct. That makes
That's why
you,
can take
yeah.
all this.
yeah, take advantage of tax. Yeah. One of the reasons, yeah. The tax deductions, yeah, exactly. So there's benefits when you take designations. First of all, it shows you stronger in front of your clients, and you can get the tax deduction as well while you're doing it. Okay. Any further questions on that? Okay. All right. 6. Travel expense deductions. You're going to like that one too. Schedule C box 24A. So let's say you're going to family reunion this month and you're going to stay in a hotel in Vegas, okay, for 5 days, and you're going to be taking Ubers to move around. You're going to be taking meals over there. All this stuff is tax deductible because you're traveling for business purpose. You can either travel for either educational purposes, like because you're taking a training over there in family reunion, so that qualifies the travel expense to be deducted, or you can be traveling for business purposes. Let's say you're traveling to meet a client in order to discuss listing his home in California, okay? But he lives in Arizona, for example, and you're going there. That's just an example. But here you're traveling for educational purposes, which is allowed. So whatever you spend there, lodging expenses, hotels, motels, you can deduct that. The airfare tickets, you're going by train, you can deduct that. Transportation during travel, car rental, if you're renting a car or if using Uber, all that, just keep the receipts and document it why we were doing that travel. So this goes under travel expense deductions, as long as either for educational or for business. Any questions about that one? Good? Anybody know about that one? Okay, good. All right. Home office deductions. Why?
Stay away.
This is Schedule C, line 30. So this is a benefit that we could take advantage of that does not cost us money, because if we have an office at home, but the only thing about it is it has to be a dedicated space. It has to be like an extra bedroom. It has to be, could use the garage, it could be a basement, whatever it is, but it has to be a dedicated space. It cannot be a desk in your bedroom. You just have to have a dedicated space where you can identify the square footage. And there's 2 ways you can calculate that. Simple methods, which is multiply the square footage of whatever the designated space is. Let's say it's 200 square feet multiplied by $5, for example. It will be like you can deduct up to $1,000, but the maximum is 1,500. Or itemize all your home expenses, whether you're renting or you own the home. So if you're renting, you're going to put in the rents and whatever utilities you're paying, and you're going to see how much square footage you're using. Let's say you're using 200 square feet in a 1,000 square feet home. So that's a 20% percentage. So let's say the rent plus utilities cost you $3,000. So you multiply 20% by $3,000, that will be your home office deduction. If you own a home, it will be your mortgage with all its interest and the property tax, and if you're paying association fees, and if you're paying utilities, all that, and divide and get to a number and multiply by the percentage of your office space in the square footage of your home. So you can use this one or this one. Go ahead, Randy.
Cap on that one, like I was 1,500 simple.
No, no, because there's no cap because, you know, this is what you're paying for your home and the percentage of what your square footage is. What is? I don't know.
That $1,500.
No, it's for the entire year.
Does a corner in the living room work?
Corner, no, they have to be designated space. It has to be a room, a bonus room, or, you know, a garage, but it has to be a designated. That's what they say.
I can't use-
You can close, of course, you can do it that way. But again, I don't think the IRS is going to police you.
Yes.
Okay. But if you, but it depends on how you present it. You know, if you're saying I'm using a corner in the living room or I'm using a desk in the bedroom, it's not acceptable. Dinos. Yeah, you could just present it as a designated area that you use only for business purposes. Yeah. Dinos, exactly. Yeah. Dinos had a question. Yep. Go ahead, Dinos.
Office here. Something like I am. Can I still write off my home office?
Yes. I'm going to show you why, but yes, that's a very good question.
How much is deductible? Is there a limit or is it all of it?
Well, yeah, it depends on what you're paying every month because you can verify you're paying rent so and so or you're paying mortgage so and so, and you're multiplying by the percentage of designated area of your office. So it is.
Okay.
You had a question. I keep missing you. I'm sorry.
If I deduct that home office.
Yes.
Go to sell my house.
Okay.
Am I gonna get billed for that?
If you deduct your,
Yeah. Sell my house, I should pay. You know what I'm saying? It's never been bad. My accountant.
Well,
won't do that for me, 'cause
look.
I can sell that. Pay up.
well, if it's your primary residence, you're going to be exempt from capital gain tax up to 250. And if you're married filing jointly, you're going to be up to 500. Assuming, you know, but I don't, I don't see the relevance of you selling the house, of you getting the home tax deduction. Yeah, exactly. Yeah. Yes.
I have, not in real estate, but I have worked out of a home office for probably 20 years.
20 years.
plus.
Mhm.
And I was always told by more than one accountant
Yeah.
and
Since you're all asking interesting
Oh,
questions, I'm going to put
yeah.
microphone for everybody so that the people on Zoom can hear.
So I've always been told that taking the home office deduction
Mhm.
increases the red flag potential for an audit,
This is a question.
and that
No,
it's not really, you're not able to deduct that much that it makes it worth having to go through that whole process.
that's where you're going to have to ask your tax preparer, is it a red flag or not? But whether it's legitimate or not, it's legitimate.
Oh, it's
Yeah.
legit, yes.
So I think it would be a red flag if, let's say you're saying you're getting a deduction for the home office for like $7,000. That's a red flag. It's a lot, you know. But if you can, validate or substantiate that your mortgage payment is so and so, and the association fee and the utilities, and you can show that to the calculation if they audit you, then you're good. Where does it say?
Right.
Yeah.
Okay.
So it's all about substantiation, you know. Okay. So that's for the home office deductions. Number 8 on the list, office expense deductions. Next schedule C, box 18. You know what that is, guys? Anybody know that one?
Office expense?
That's-
Exactly. Office supplies, papers, pens, stationers, equipment. You can buy a new laptop for your business, buy a printer for your business, ink toners, computer software. You're buying MS Office, lead generation software, devices, your iPhone. You're getting an iPhone for your business or a telephone for your home office, social media equipment, audio equipment, lighting fixtures to make you look good and for social media, photography or video equipment. You're buying drones or cameras. All this is normal course of real estate business. It's ordinary and it's necessary. Nobody can argue that these things are not part of your business. Okay? So, like if you buy a sound system, this has nothing to do with your business, but we do need cameras and videos or drones for our business if we want to go into that. Yes,
Again, with like an iPhone.
yes. Doesn't matter how much expensive it is. It's an
No,
iPhone.
no, I get that. But if it's also my personal phone,
Well, you're buying it for business purposes. They're not going to measure, how many
Okay.
personal calls have you made on that phone. So
Okay.
no, it's fine.
all right.
That's your whole database.
Yeah.
I would argue, if you have everything in command. then
No, that's
everyone
Yeah,
does.
exactly. Anybody could be business.
That's true.
Even if it's
That's
your
true.
cousin, even if it's your father, or if it's whoever. Yeah,
Potential.
yes. Yeah.
So-
I have, for example, a subscription with a telecommunication outside of the US. So it's
Subscri-
something abroad, but
to
it's
do
also
what?
related to business.
Subscription to what?
Like, just like T-Mobile, just imagine it, the T-Mobile of Turkey. Can I deduct this also, or can I
Are
deduct?
you using it for business purposes?
Yes,
Okay, then
even if it's abroad.
Yeah.
Okay.
yeah, if you're using it for business purposes, yeah, I'm using that to get business from abroad. Yeah, so it's
Okay.
okay as long as you're using it for business purposes. Yeah. Okay, number 9, liability insurance deductions. Okay, we all know that one, and that's on our monthly office bills. That's the E&O payments that we pay, either the $50 every month or the $500 that we prepay every year. That's something you can deduct. Real estate risk management, the $149 that we pay in every transaction. Okay, or the $65 for rental. All this, the real estate risk management can go either under liability insurance deductions, or it can go under another category coming up, which is, the professional fees you pay to, like, attorneys, for example. So the risk management can either be treated as liability insurance deduction or as an attorney fee, but we're going to get to that, okay? So these are deductions that you can use in Schedule C, Box 15. Any question about that one? Okay. Number 10, professional services deductions. What I was talking about. We sometimes have to pay to attorneys in order to get, some work done. Like we pay the TC fee, the transaction coordinator who prepares all your files so that you're in compliance, so that you can get paid your commission, accountants, bookkeepers, the tax preparer that you pay, that's something you can deduct. Attorneys, if you're paying money to attorney, that's deductible. Marketing advisors, if you're going to someone to do a marketing campaign for you, you can write that off. Financial advisors, okay? Business consultants, other specialists, all these stuff. And if you want to put in the real estate risk management here under the category of attorneys, you can as well. But the idea is all these items are deductible and they go in Schedule C, Box 17. Any questions about that one? Okay.
So I can deduct my CPA fees for doing my taxes?
Yes,
Yeah.
yes, of course. Yeah, of course. Brokerage fees. That's Schedule C, Box 10. This is what we get on our office bills. The associate tech fee, the $75 every month. The annual renewal fee, which we got charged in January, the $25 every year. The desk fees, what Dinas was asking, like whatever, you're paying for your office space, whatever that number is, get it throughout the year and put it here. Broker referral fees. If you're paying another broker as a referral fee, that's something that goes there as well. Paper copies and printouts, when we pay for colored copies in the office here. And what if we print something like a binder or anything like that? That's also deductible. Any miscellaneous fees like the key fob, when we pay $30 for the key fob or whatever folders or binders we have that we get charged for, all this is tax deductible. Okay, it goes under the category of brokerage fees, and that's Box 10 in Schedule C. Any questions about that?
Now, I don't know if you mentioned this in the previous ones, but what about personal insurance? Are you gonna get to this? Like health insurance?
Oh, it's coming to.
Oh,
Good,
it's
good,
coming?
good question. Yeah. Good question. Good question. Yes. All right. 12, rental income property loss. Okay. This applies if you own an income property. Okay. But it's a deduction that's worth mentioning because We are in a way considered real estate professionals, but there is some items that have to be complete in order for us to be considered as real estate professionals. And I'm gonna explain right now. If you own rental income property, in general, any taxpayer, that, actively participates in his, rental income property can claim a deduction for up to $25,000 of loss every year, up to 25. You cannot exceed that. So let's say you're just a regular person and you have a loss of $25,000, then you can go deduct that. But if you have a loss of, let's say, $30,000 or $40,000, you can go up to 25 only. But us real estate professionals, and I'll show you what the qualifications must be, we can have unlimited amount we can deduct on a rental income property loss. First of all, let's just say how we get a loss. The good thing about rental income property is there is something called depreciation we can take advantage of. That's a non-cash expense. That's an expense on paper, but it's not a real expense. That reduces your income. So let's say you're making a rental income of $12,000 a year, and you had a depreciation of $15,000. So you have a positive cash flow of $12,000, but you have depreciation of $15,000. That would put you at a loss of $3,000. The $3,000 you can claim it as a loss, whether you're a real estate professional or not. But what I'm talking about is if you're having a significant loss, you can't claim up more than $25,000 unless you are a real estate professional. So do we qualify as real estate professionals? There's two stipulations and that mainly determine that. You have to do 750 hours a year of real estate. 750 hours a year. Second thing, it has to be your primary job. You can't be, for example, an accountant and you're making more hours on being an accountant than being on real estate. So that won't qualify you. So if you do have a rental income property and you're doing more than 750 hours in real estate and that's your primary job, most likely you qualify as a real estate professional and you'll be able to claim if you have more losses than 25,000. I know it's a confusing deduction here, but that's something you can discuss with your tax preparer if you have an income property. Any questions about that? Okay. Selling expenses deduction. That's Schedule C, Box 27A. What is that? Selling expense deduction, sometimes when we're about to close the deal, we may run, for example, into a situation where the buyer is backing out or the seller is backing, whatever, and you have to salvage the situation. Like you would pay for the home warranty. There are certain repairs that the seller and the buyer are not agreeing. Some agents just want to salvage the deal and some agents don't care. Let it break. I'm not paying anything. But some agents want to do it. If you decide to move forward, like pay for the home inspection or pay for the repairs for the client to salvage the deal, you can deduct that as a deduction. Did you know that?
No.
You can. So let's say you paid $5,000 in order to salvage a deal. As repairs, just keep the receipts and note to it that you paid that amount of money in order, as part of your selling expense. You paid for the appraisal, you paid for the home inspection, you paid for the home warranty. Some agents do it, some agents don't. I personally don't do it, But sometimes, situations happen when it's too much of a good deal to let go. Agents would just, jump in and do that. But if you decide to do it, at least it will be tax deductible on your side and take advantage of. These are the similar things that I'm talking about that no matter how good your CPA is, he would never think of that, So, but if you're unprepared with that, you will use it. Yes, go ahead. Staging. Okay, if you decide to, that's a very good point. If you're paying for staging, that's something. Yep, very good point.
Because I pay a stager, I'm the stager.
Oh, okay. You're paying yourself. Okay. Okay. The cost you want it. Okay.
That be under marketing though?
No marketing for your brands. You're always marketing your brands. But the staging, this is something that you're supposed to be, the client's supposed to be paying for. Yes. Photography will go under marketing. Exactly.
Marketing.
Yeah, the marketing, yeah. Photography doesn't go under selling expenses because that's something you're marketing with. Or under professional services. Go ahead. Photography for listing, yeah, would go either under marketing or professional services, people you hire. Okay.
Is it okay to have an agreement with the client where you take care of the expenses and then he reimburses you?
Oh, and you mean like for a seller, let's.
Yeah, you tell him, I'll take care of everything, you can reimburse
Well,
me
as
then.
long as he reimburses you, there's nothing to report then. Yeah, you can.
Okay.
Yeah, that's assuming he doesn't reimburse you in this case, then that's when you book it. But if he's reimbursing you, then yeah, you're not gonna be needing to do that. But that's a good question as well. Any questions about that one?
I have a question. Hi, it's Rita on Zoom.
Hi, Rita.
How are you?
I'm good.
So, question on the staging. I have been not organized, I guess, and not putting it in the right deduction, and my CPA didn't really advise me otherwise. So, I've been putting the staging with marketing, thinking that it's marketing for the home. So, I should not be doing that. It should be separate. It's important to have this organized in a certain way so there's no red flags. Is that what I'm understanding?
No, it doesn't matter. The only reason I'm categorizing this for you, first of all,
Uh-huh.
it should go in the proper box in Schedule C, but it's still a proper deduction. So don't worry
Got
about
it.
that. As
Okay.
long as you have
Okay.
the evidence in case you get audited to
Okay.
substantiate, yeah, you did pay it, then that's fine. Don't worry. Your
Okay.
accountant doesn't
Very
need the
good.
receipts, but the important thing is you have the receipts just in case you get audited. That's all.
Got it. Okay. Thank you.
You're welcome. But you're never gonna, let's say, God forbid, you get audited and he's gonna tell you, well, how did you put this in marketing? It should be, and so, no, it's not gonna be like that. But
Okay.
as long as you have the proof to show that you did it for business purposes, that's all.
Perfect. Thank you.
Okay, you're welcome. Any good questions? Any more good questions like that? Okay. You all are asking very intelligent questions today. Thank you.
We want to save.
Employee and contract labor expense deduction. That's Schedule C, Box 11. So as we, expand our business, we most likely are going to hire help. Okay. So we can get a social media expert, we can get a virtual assistant, we can get a professional photographer, as we mentioned. Hired employee salary. Like we can put someone on salary to do like cold calling for us, for example. Team member compensation. 1 hour, you have a team and you're paying somebody a fixed amount of portion of money. A hired cold caller, as I said. All this you can deduct in Schedule C, Box 11.
ChatGPT. Is it like if you subscribe to ChatGPT, for example?
Well, it's not
You're
employee
using
or
it for
contract
business?
labor.
Okay.
You can use it on another
another
different
section.
category, but it's not something in the employee contract labor. This is some kind of person you're hiring and paying money to. Okay. Any question about this one? Okay. 15, gifts deduction. Did you know that you can deduct your gifts that you give to your clients? Okay.
Is it still $25 each?
I don't recall that there is a limit, but you can discuss that with your tax accountant.
Giving
I'm not
everyone
sure.
gifts this year.
I don't recall that there's a limit for that. But anyway, we all have to give like closing gifts or holiday gifts or birthday gifts. And during that time, when you do the gifts, it's always a good time to ask for business. They will refer you business because it's a good time. They're enjoying their gift and they're happy that you're giving, you're remembering them. And they most likely will refer business because we succeed in our industry because of referrals that we get from past clients or sphere of influence. So that's something you always should take advantage of, I don't remember if there's a limit for that because as you know, I'm not even a tax preparer. I have a CPA background, but it's in auditing financial statements. So I don't remember that part, but that's the part where you need to ask your CPA or tax preparer, is there a limit on gifts or not? But just know for now that any gifts you give to your clients, gather them up and give it to your accountant and see what he says. And I don't think it's going to be an issue because let's say you gave one client a gift card for $200, okay? And you're going to report $200 to the tax preparer. The IRS is not going to know if this was given to like 10 clients or 15 clients, or not. They're just going to see $200. So it really doesn't matter unless like you're claiming, I gave $20,000 in gifts this year. So that's something, that's a red flag. Unless, so.
I can't.
Yeah.
So you're gonna have to, I think you're good even if you're giving your clients up to $100 every month. So the important thing is just it has to look good according to your other expenses and income, especially your income. So if you're making $500,000 a year, different than you're making 100,000, different than you're making 300,000, the expense should be in the same proportion. Any questions about that one? What is it? Yeah. On Google? Okay. Well, you have a lot of clients, so how can they verify? So exactly. Yeah, exactly. So you might have 200 clients, so but anyway, it has to be in good proportion with what you make as income. That's what I'm trying to say.
Question.
Medical insurance tax deduction. This is Schedule C, Box 14. So if you're paying any health insurance premiums, any dental insurance premiums, you can deduct that as well. Okay? The IRS allows that.
If there's a package, if there's a family package for it, how do you account for that? So let's say they're giving you a discount on this health insurance based on you and your wife and children, let's say. How do you just take a section for you, or how do you
No, you
account
just
for
deduct
this?
the whole thing.
You can do it, so I can put my wife on the same plan and then remove everything.
No, I don't believe you have to separate just because you have adding your wife and children. No, it's fine. It
Okay.
should be okay.
But it's just the premium.
Yeah, you mean like not the medicine or co-payments?
Pays, talk to your CPO.
Yeah, talk to your CPA. There is something in the itemized deduction when we get to the personal deduction side that's called health, I believe. But you can deduct up to 7.5% of whatever. I think that's where it would go in this case.
That's so much.
Yeah. Yeah. So, but that's the part where you need to talk to your CPA. No, very good questions. Retirement tax deduction. You can use that one here or in the personal as well. So if you're putting money towards your 401k, your SEP IRA, your Roth IRA, you can use that deduction as well. There are certain limitations to some of them, like for the SEP IRA. I'm not sure it's 6,000 or something, but that's something you discuss with your CPA. Again, this is not supposed to be a comprehensive course in taxation, or I'm not preparing you guys to go prepare taxes for people. This is just to highlight important things so that you can remember when you go to your tax account, oh, I need to take this to my tax account, I need to take that, can I do that? Oh, yes, you can. That's stuff like that. So the intention here is to know what you can use or utilize, because many agents underutilize that and overlook it. But it's not meant to train you to become tax preparers, All right. 18, cell phone tax deduction. That's going to be Schedule C, Box 25. So basically, your iPhone bill, usage bill, and your data plan, whatever it is, that's something you're using your phone for business purposes. I know you're going to think to yourself, okay, but I'm doing some personal calls as well. Well, it really doesn't matter because they're not going to go in police and say how many business calls did you make and how many personal. So in the end of the day, whatever your monthly bill is, 100 and something, they're not going to, care about that $30 you're taking as personal calls, And in our line of business, anybody we talk to can be business, even if it's an immediate family member,
Yeah.
So that's something we can use.
Is that a dollar for dollar deduction or is it a percentage?
For the iPhone?
Yeah.
No, just as long as you have the bill, that's fine.
It's the same when you buy, it's the
But-
same, yes. Yeah,
No, I just want to add something before, but remember your question. But let's say there's many lines on the bill. Like you have your personal line and there's your wife's line and there's your son's line and your brother, whatever. So be sure to separate your bill, But that's because they're not doing real estate. But to go back to your question, yep.
So let's say I get a car and I put it in the company's name,
Okay.
so I can depreciate the whole amount, right? Let's say I pay $20,000. I can remove the $20,000.
Yeah, there's certain guidelines about the car. It has to be, I don't know, 7,000 pounds or something like that. There's guidelines for that. You can depreciate it all in 1 year. That's true. but your accountant will be given to tell you the latest guidelines on that, how much, because it has to be a certain size, a certain weight. And yeah, you can depreciate it all in 1 year, or you can over a certain number of years. But that's true, yes. Now we finished the business tax deductions. We're going to go to personal tax deductions, which most of us are familiar with. We really can take benefit of that if basically we're homeowners. But if we're not homeowners, well, most likely you're going to get the standard deduction, which is 14,600 per person. If you're married filing jointly, it will be 29,200 out of your income. Remember how we saw that tax bracket in the beginning? How it was up to 11,000 and then up to, I don't know, 37,000, stuff like that. If you're getting the standard deduction, you're going to reduce all that income. That's taxable income that you'll be using, okay? But let's say you own a home. The things you can utilize when owning a home is the mortgage interests, and that will go on Schedule A this time, Box 8A, or home equity loan interest. If you took a home equity loan from your home, it will be Schedule A, Box 8. That's something you can also deduct the interest on that. That is points paid when you buy a house. You can deduct that in Box 8 on Schedule A. And property taxes, Schedule A, Box 5B. All these items you can deduct. So I'm talking to you now on the personal level. If you own a home, that's deductions you can take advantage of. Charitable donation, when you itemize deduction, you're able to use whatever donations you made, okay? Go ahead. Oh, the renter, they won't be getting the itemized deduction. If you're renting, you'll be getting the standard deduction, which will be 14,600 for filing individually, and if not 29,200 if you're filing jointly, okay? So because all these items, because you always compare which will get you more benefits. So let's say you're filing individually and you're paying 14,600, I mean, you're getting 14,600 as a standard deduction. And then when you itemize all these deductions that I was just going through, like the mortgage interest, the property tax, the points paid. The points paid, by the way, is something that happens only when you close on a home, or if you're getting a home equity loan and you close on that. So that's not something every year that you get. The mortgage interest is something every year. The property tax is something that's every year. And the donations is something that you have every year. So you can, if you add them up all together and they come more than the standard deduction, that's when you would utilize the itemized deduction. If not, then you're gonna go with the standard deduction.
How do you record a donation? There's no receipt.
Well, I always advise, if you're making a donation, make it with a check. If you're doing, for example, to KW Cares, we can provide you with a receipt that you paid to KW Cares from here, because it will be on your office bill. But if, for example, that for disaster reliefs, or other charities, just try to have some kind of pay it with a check. Don't pay it cash, because they only don't believe in cash, That's for the personal deductions. For the last ones is investment tax deductions. That's, for example, if you sell your home and there was a capital loss, you can deduct that on Schedule D. Stock investments, you can deduct that on Schedule D as well. Retirement and 401k tax deductions. Same idea that we used before earlier in the individual tax deductions. All these basically are deductions, but these are a little bit more complicated, where you need to discuss with your tax accountants, because they are related to stocks and selling real estate. And usually when we have a capital loss, it usually has to go against a capital gain that you made. But the details are with your tax preparer. I'm just giving you this as additional bonus features, Now, how to maximize your tax deductions every year. We're almost towards the end here. You got to keep proper bookkeeping in place, okay? Scan all receipts and invoices whenever you spend something for real estate, whether it was coaching or you bought something for real estate or you paid for something. Try to scan it and save it on a folder on your phone, for example. Dedicate a credit card or bank statements, bank accounts for spending money for real estate, so that when you always want to remember what you did, you look at that credit card. Oh, that credit card is solely designated for real estate. I spend on it everything, you know. So you'll be able to pull up from the statements all that. Yep, go ahead.
Is this again a good substitute for like scanning all the receipts if we just dedicate one?
Most of it, yes, but like for example, if it's a dinner, you know, you just to make notes to say, for example, what that dinner purpose was for, and you know, and you have to multiply that by 50%. But your tax accountant will take care of that. But usually, I would say yes, because the statement shows that you paid the money. You're not just
Really
bringing it
hard
up.
to just scan everything.
Yeah, I know, but the statements should be good enough. Categorize all your expenses based on tax deductions. It would be good if you can categorize that. Some credit cards do that for you, by the way. They categorize what was meals, what was whatever, you know. Keep log of your business mileage. It would be a good practice in case you want to use it. And do proper tax planning, okay? Last item for today, tax planning. So develop a tax plan to minimize your tax burden and ensure you take advantage of all available tax benefits. So we know now what all the tax deductions we can use to our benefit. Now we need to develop a tax plan to minimize that tax burden. So apply the tax deduction maximization techniques you learned today. All those tax maximization, those points I've been going through, those ones over here, apply them, okay? That's part of tax planning. The other thing, if you file your business as an individual, consider if you are making more than $50,000 a year in net income. In net income, consider making a corporation. Okay? Establishing an S corporation, you'll end off better for tax purposes. There are many reasons for that, but I'm just going to list two of them. First of all, the S corporation is least likely to be audited than a Schedule C. Most likely when the IRS decides to audit, they audit the Schedule C more than an S corporation. Number two, there is tax favoritism when it comes to S corporation. In what way? Let's say you make net income $100,000 after all the deductions, okay? You still have to pay on that employment tax, self-employment tax of 15.3%. So you're paying out of 100,000 net income, $15,300, okay? If you're an S corporation, you can give yourself a salary, a reasonable salary, like $40,000. $40,000 times 15.3% self-employment tax would give us what? Give us like around $8,000.
I was told there'd be no math.
Yeah, sorry. Yeah. Let's go. Yeah.
6,100.
6,100. So you're saving $8,000 just by becoming a corporation.
Can I mention something, James?
Okay. Yeah, go ahead.
I'm a Zoomie.
Okay. Yeah, go ahead.
I'm sure you know this because you've been doing taxes and all that for so long. I found it, I was advised and I found it easier to create an LLC and then request from the IRS to file as an S corp. It's just cheaper and easier to manage. So that's just my 2 cents on that.
Yep, exactly. I know. And now you want to say something. I'm sorry.
So if you're, I'll do 6,000 month is the max, 6 times 12 is 72,000. If you make enough money, your corporation can match that. So you can really maximize, no, take that back, it's only 6,000 a year. So, but then your corporation can also match that 6, so it's double. If you're doing a self-directed 401k, if you're an S corp. So I do that, and I pay myself because when you want to get a loan or something, you need a W-2. Yes. To show that you have income. You know, people think of self-employment income as a little.
Yes, I know what you mean. Yes. Okay. So that's basically, it's a good idea. If you're making more than $50,000 in net income a month, it's recommended that you do an S corporation, you know. But if you're making less than that, it's not recommended. Wait till your business expands and then you would, you know, do the S corporation. That would be a good tax strategy. Now we open it up for general questions right now. Because that was the end of the class. Go ahead. Yes, Gary.
So with either an S corp or an LLC, how does that play well together when you're filing a joint return and your spouse is not part of that corporation?
Can you rephrase the question? If you're doing an S corporation?
Well, okay, let's say I had an S corp
Okay.
and that's covering my income, my deductions, blah, 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 blah.
Okay.
But I filed jointly with my husband.
Okay.
He gets retirement income.
Okay.
He's retired. So all of his income is from investments and social security.
Yeah. And the income that you own from the corporation you own will just flow to your 1040 with him.
To the 1040.
Yeah,
Okay.
yeah, yeah.
All right.
And you can make him as a co-owner with you
Okay.
as well.
And then his income would be,
Well, then you make him a salary as well, like you.
so
Yeah.
he'd be salaried as well.
Yeah. Okay. Yes, go ahead.
This might be too technical, but is it better to like buy the house under the corporation or a person? For tax benefits?
Well,
Talk to your CPA.
yeah, exactly. Yeah, yeah. Talk to your
That's
CPA about
why I
that.
said
Yeah,
it's
yeah,
too
yeah, yeah.
technical. I thought you.
Yeah, talk to your CPA about that. Yeah, yeah. Because this is, I don't want to say something.
Yeah.
Your CPA, and yeah, this is something.
Very
Yeah,
technical.
yeah. Any other questions, guys?
What can an escrow cost to like open up for me? Like the average price?
Anywhere from 1,000 to 1,500 to the accountant will make it. And also, that's a question for your accountant, and your accountant will tell you how much it costs.
And it's tax deductible.
Like nothing, then it's $800 fee.
Yes, and franchise tax board. Yes, exactly.
Okay.
Yes, that's a good point. Yes, yes, that's right. Thank you, Don. Yeah, if you can you're savvy and you want to research Secretary of the State, you can do the paperwork yourself.
What
Yeah.
about clothes you use for business?
No, sorry, what?
Clothes you use for business, like suits and.
It has to be 100% for business. It has to have the branding of the business. So you can't buy a nice suit from Macy's and say, I'm using this.
So
Yeah.
if I put the name of the company just here, that's.
Yeah, it has to have the branding of the exactly of that.
Buy them
But again,
polos.
who's going to police that again?
Yeah.
But it has to have the branding of the company.
Okay.
Because if you use a nice suit, you can go to it with a wedding, you can go to on a date, but you're gonna still, it has to have the branding of the company. Yeah. Good questions. What else?
If I have more than one source of 1099 income.
Hmm.
So I'm 1099 real estate, I'm 1099 for a consulting business, I'm 1099 for my acting. How do these all play together? Because I can only deduct my office supplies once.
Oh, I mean, if you have many businesses, is that what you're saying?
If I have different businesses, I'm assuming they all get their own Schedule C, or do I lump them all together?
No, everyone is going to be different. It has to be, every business has its own Schedule C. And if under different corporations, it depends, how your
Right.
accountant prepares it, yeah. And you have to, office supplies for that is different than the office supplies for that, whatever it is, yeah.
Okay.
Go ahead, yeah, please.
Yeah, so I have Schedule Cs,
Okay.
and my tax preparer keeps saying, you can put them all as one if you want, but then I use different ones for different things, like if I make more money in real estate, I put all my supplies on that one,
Okay.
so that's.
That's a smart technique, yeah, exactly.
Right. Right. Okay.
Exactly, yes, yeah.
Put it where you need, or there is a way I guess you can combine the businesses and do one Schedule C. I just don't think that's clean. But if you had everything separated for an audit.
Yeah.
In preparation of that, then I guess it doesn't matter. You have to pay for each one of the Schedule Cs, and it could be like, what, 300 a form or something, maybe not for district tax.
Okay.
Good point. Good point, yeah.
I'll ask my CPA.
Yeah. The close for, yeah, I was just asked that question. Yeah, yeah, yeah. No, it's okay. Don't worry. It's all right. It only has to be clothes that's branded towards the business. Yeah, like KW, for example, clothes, or if you're working whatever book. But you can buy a nice suit or nice dress. Say I'm going on a, yeah.
Does this include accessories? So if you buy a watch and.
Yes,
Yeah.
it includes accessories.
If I put Like the name of the company on it.
What about the women?
Well, unless,
My, my, my.
that'll be nice. Yeah, women's nails there. For those ladies on Zoom, they are asking if nails can be deducted. That would be nice. Yeah.
Yeah, it's called personal grooming. Yeah, for business. You can't.
That be considered.
Well, I would ask your CPA exactly. I don't want to be giving wrong advice about that, but yeah.
We've gotta save money.
Yeah. Any,
When I buy my Starbucks, I make him write the name of the company on it. Right? It's brand new.
any further questions?
Thank you.
No, really?
Very-
Welcome.
Very.
Welcome.
Thank you, James.
Thank you.
That was very informative.
Thank you. Thank you.
I noticed there was there were like 4 comments in the chat. I don't know if you've got questions in there or not.
I don't have access. Let me see Dougie. Where's Dougie is? Because Dougie has the computer.
Oh,
So I'd like to get a, so you know.
I'll give you my card so that you can email me and I'll give you back the.
no,
Is Dougie here? Dougie?
right. No, my ex-wife was an escrow officer. And she.
What was the questions that were on the chat, Dougie?
Because she's the one thing. You know,
Yeah.
the hair, the makeup, you know.
So we can get a receipt and you're putting it.
Oh, okay. You're welcome.
This was helpful, James. Thank you so much.
You're welcome. Thank you. Were you listening? Okay, that's good. Thank you.
Someone was thanking you.